Compensation versus ownership for key employees. A business owner who wants to share ownership of the company as a way to motivate employees could possibly open up a real can of worms. Can an owner really improve his or her situation by including some or all employees in ownership of the company? There are arguments for and against employee ownership, and our panelists will explore some of the more common issues. What are the downsides of employee ownership? Can cash be as strong as a motivating factor? What kinds of employees will the scenario work best with? And are there some people who are not cut out to be owners? Learn the pros and cons of key employee motivation and ways to save your clients' sanity.
Why give stock ownership? Well, a number of reasons why you would do that. But probably the biggest thing that we're seeing out there is engagement. We started to work with a group out of a college university, and they're putting together a statistical analysis to do a survey in different organizations to say what motivates people to come to work. And based on a number of factors, they come up with varying levels. So if you're a manufacturer, you know, what motivates someone on the floor versus what motivates someone that's upper level management. And we're finding out with millennials it's a lot different. So, but some of the other things, retention, golden handcuffs. You know, you want to keep your best people. You don't want to lose them. Ownership, feeling motivation, succession of the business. That's a clear one. More likely to affect change in the organization and deal with underperformance. And all of these could be true of the compensation awards too. Lack of potential candidates to replace current workforce. Expensive to train and recruit, and I'm sure a lot of you know it is extremely hard to find top talent today. You want to make them feel compelled to stay, that they're part of a bigger picture, and that's really true of millennials today. Risk management. Means, motive, and opportunity. You want to give them the means to improve the company performance, motive to care about company performance, and opportunity to do something about company performance.
Can I make a comment about key employees?
Yeah.
When you talk to your clients and you ask them who a key employee is, you're going to get some pretty interesting answers. One is, oh, my bookkeeper. I mean, without her, I'd be out of business, right? And so the example I give them in our CPA firm, I say, if our administrative staff didn't show up, we'd be out of business in 3 weeks. If the partner group didn't show up, we'd be out of business in 3 years. Okay, but it doesn't mean that the administrative staff are key employees. They're important, but they're not key. So it's very important that you identify when it talks about key employees who are really instrumental to the future of the business, not just keeping the doors open for the next week.
Very true. Typical situations where you see a stock process of compensation, clearly companies that are planning to go public or be acquired by a public company, such as high-tech startup software companies. Closely held companies with owners looking to sell some but not all of their stock, commonly done with ESOPs. Traditional closely held companies that will stay private but do not have a successor. Apologize for the typo there, but do not have a successor. Some of the common types of employee stock plans, one that we see quite a bit of in practice, and I don't know if Paul does, but phantom stock plans.
I prefer them.
Yeah, I do too. Especially in privately held companies, because what it is a determined value based on a formula, and you have a lot of flexibility on the date at which you award the phantom shares. And so they feel vested in the fact that that value, as it grows over a period of time, and usually it's a 3 to 5 year vesting period, they feel like they're part of the company, but yet you haven't given them true ownership in the sense that they have voting shares in the company.
Can we give an example of how a phantom stock plan would work?
So a company has 2 key employees in management, and I had this situation, large company, 2 key employees that they were afraid they were going to lose. They gave them phantom shares 2 years in advance of an exit, in this case. And when it got to be at the point at which the company was going to sell to another public company, those key employees were awarded significantly because they helped build that company up to the point where it was like a $30 million company when the phantom shares were awarded. When they sold, it was $60 million. So huge benefit to the owners. In the end, everybody won, and they got a significant bonus at the end. It's a compensation. It's not a capital gain. So from the standpoint, it goes right on their W-2, but they still felt like they were vested in the company.
And the employer gets a tax deduction for those payments.
That's correct. Yep. Stock appreciation rights, I'm not going to talk a lot about. Employee stock options, there's two types, and I don't see a lot of it in my practice, but other than maybe a client who brings to me that has ISOs or non-qualified stock options. With ISOs, you see it a lot in public companies where they have the grant date, there's a vesting period, an exercise date, and then if they want to, they can sell the shares right away. It's ordinary income on the W-2, or they can pick it up, exercise the shares, and then hold it for a year, and then sell the shares and get long-term capital gain. So there's some incentives there for people that have stock in a public company. Non-qualified shares, when they exercise, it's ordinary income to the recipient immediately upon exercise. Employee stock purchase plans are usually done with public companies, and probably the downside of this is that everybody gets to qualify if you've got 2 years of service and you meet certain requirements. ESOPs, I don't see a lot of it in my practice. I don't know if you do,
I don't
Paul.
either. How many of you don't know how an ESOP works? Everybody knows how many of you know how an ESOP works? Let's do that. Okay. Well, it's about half of you. So the biggest limitation I found in an ESOP is basically the owner of the business walks over to the bank and says, I want you to loan me $10 million because my retirement plan is going to take ownership of my company and my employees are eventually going to buy it. What the bank says is, okay, here's the $10 million, but guess what you need to do, owner, with that $10 million? You need to keep it on deposit at the bank, and it's going to be collateral for the loan. And so the business owner divests himself of ownership, yet he still has an ownership risk because if the business doesn't perform, he loses his money. He or she loses his money. So that's the single biggest limitation for ESOPs. Conceptually, they sound great. A lot of people hear, hey, I can sell my business to my employees. Isn't that wonderful? But when you step through the process of the cash goes from the bank to you, back to the bank, and you don't get to keep it until everything's satisfied, they typically don't get implemented. I've done 2 in my career, and they're before the rules changed, where we had a single owner, and we were able to shelter income for about 4 or 5 years and through some tax strategies. But once their IRS changed the rules because people are taking advantage of that, I haven't seen any more ESOPs implemented.
No, I haven't either. Another option is restricted stock. I'm not going to talk a lot about that either. A phantom stock plan is also fitting in with a restricted stock. One thing that's not on here, and Paul and I talked about this morning, and I should have probably had on here, is what we're seeing is a lot of, in my practice anyway, a lot of LLCs or family limited partnerships as a means in which to get ownership to either key employees or family members, and do it at a discount. Although there's legislation that's maybe going to end that, hopefully not, but there's current pending temporary regs that will eliminate the discount on minority discounts. But I don't know what you...
Have you got, who here is familiar with profit units in an LLC? Okay. Profits interest, profit units, the same thing. You'll hear Donald Trump talking about a carried interest for these hedge fund managers. It's a similar thing. As if Eric and I have an entity that's worth $1 million and we want to hire Elizabeth to come work for us, and we say, all right, Elizabeth, we want to give you 10% of the business to come work for us. The IRS says if we give her 10% of that $1 million value, that's a taxable transfer to her because I'm transferring current value to her. So the ownership would be 40-40-10, and she'd pay tax on $100,000. If the business failed in a year, it could be a real problem because she's got to pay tax on $100,000. That's if we give her capital interest or if we give her stock in our company. For an LLC, in most entities, our CPA firm has, we'd use an alphanumeric system to identify our clients, and we've gone to 10,000 and we flipped over. Now, they're not all current clients, but gives you an idea of the volume we have. And I can list a number of corporations, C corporations, on 1/2 of an 8.5 by 14, 8.5 by 11 piece of paper.
I could too.
Yeah, so most of them are operating LLCs. And even if you operate in a corporate environment, LLCs give you a lot more flexibility. So we see situations where we take the corporate assets, drop them into a partnership or into an LLC, and then the people take strategic ownership of the operating assets. But a profit unit, in Elizabeth's case, if Eric and I said, we want you to come work for us, we want to give you 10% of the business, she's like, I don't want to pay tax on $100,000. You guys might not be around in 6 months. So we give her a 10% profit interest, or profit units, or a carried interest. And what that gives her, it gives her the ability to share in the future profits of the company and the future appreciation of the company. So what the IRS says is Elizabeth has no taxable income because there's been no current transfer of value to her. All we've given her is a promise to pay something that may or may not happen in the future. Okay, and by definition, a profits interest is a capital interest if you hold it long enough. You got to hold it for a year. So if Eric and I exit from our business for $5 million and she has a 10% profit interest, she gets 10% of the appreciation between $1 and $5 million. Eric and I split the first million 50-50, and then all three of us split 40-40-10, or 45-45-10. I'm a CPA, I can't do math. 45-45-10, we split the next $4 million. The nice thing about that is the profits interest, if she has stock ownership in our corporation, if you're an S corporation, there are restrictions on distributions. You can't have preferred distributions. She gets the money when we get our money. If it's a profits interest, we can put some more hooks into her. She's got to work with us for a certain period of time. We can delay the payout of those profits interest. So it gives you a lot more flexibility in structuring compensation to her than just direct ownership of stock.
You can't take an existing C or an S corp and just do that.
Yeah, it's a great question.
I don't know how you do it.
You can.
Right.
So
Now without tax effect.
Well, so here's what you do. Let me rephrase the question. Let me answer the question this way. If you have an S corporation, and we've done this a number of times. Just recently, I brought on a new client, large retail company in southeastern Virginia. The husband died, and his will and his trust documents were on his desk to sign, and he didn't sign them. Okay, his wife took control of the company, and his son-in-law, who was supposed to get the business, was out in the cold because now his wife owns the business. And a strange daughter comes back in the picture and says, your son-in-law and my sister are trying to take advantage of you. It was a real problem, and it was an S corp. There were assets in the S corp, like one of the previous presenters said. It had real estate, it had investment accounts. And so what we did, instead of pulling out assets out of the corporation, we took the operating assets of the business, dropped it down into an LLC, and gave the son-in-law ownership in the operating entity. And that's a tax-free transfer because we gave him a 30% profits interest. So we valued the business, so let's say $5 million, and then he gets 30% of all future profits plus any appreciation above $5 million goes to him as well. So now he's incentivized to operate the business. The S corporation still remains intact up at the parent level. Nothing you can do about that. If it were a C corporation, we would have elected S status in order to get the built-in gains tax to run. But if you're in a corporate environment, an S corp or C corp environment, planning can be very problematic. Consider dropping the assets, the operating assets, into an LLC, and then allow ownership access at the LLC level.
Agreed.
The assets, the S corporation still technically owns.
The real estate.
The S corporation, yeah. In my example, the S corporation still owned all the real estate, it still owned all the investment accounts, and it owned a 70% interest in an operating LLC, which was. No, in my situation, the matriarch said, I don't want my son-in-law to have the investment accounts or the real estate, but I'm okay with him getting a piece of the operating assets. Okay, so their attorney said, well, we'll pull the real estate out and we'll pull the investment accounts out. Well, that would have triggered millions of dollars of tax because when you pull an asset out of a corporate environment, it's a deemed sale to the owners at a fair market value. So you want to keep them in the corporate environment. What we did is we took the operating assets and dropped those down. Matriarch still owned 100% of the S Corp, 100% of the real estate, 100% of the investment accounts, but the S Corporation owned 70% of the operating assets, and her son-in-law owned 30% of the operating assets. That answer your question?
Yeah, I guess my point is, you're not doing a tax-free distribution of assets to an LLC.
Correct.
No.
I mean, the LLC is still owned by.
It's still owned, right, 70% is still owned by the S Corp. It's still, right, because if we had pulled those operating assets out, it would have triggered gain.
Right.
Exactly. But you can drop assets down into an LLC tax-free. Yeah, because it's still, yeah. The wife consented to do that after much, I mean, you know, you talked about being an advisor. The meetings, they were a new client, and the meeting started off, it was several meetings, but with the meeting in which she decided to do it, I looked at her and I said, at the end of this meeting, you may not want me as your advisor because I'm going to tell you things that you don't want to hear. And what you don't want to hear is you need your son-in-law a lot more than he needs you. So the conclusion to that meeting was, I'm going to pull all the assets out of the S Corp and he can have part of the S Corp. And I said, you're not going to do that. And she goes, yes, I am. I said, no, you're not. We went back and forth. So I came up with the planning to drop just the operating assets down, maintaining the integrity of the S Corp, which is a dumb place to have real estate, right? You don't want real estate and appreciating assets in an S Corp, but that's where they were.
I'm assuming from an estate planning perspective, that key employee who owns that carry in the LLC can well shift that to finance the trust or whatever you want to do.
Subject to the limitations of the operating agreement,
Right.
yes.
Yep. Yep. A lot of times what we see in practice is that would be very limited if it's a family-owned business to where they can transfer that.
Right. In this case, yes, there's no transferring outside the family unit. That's a good point.
So just to be clear, you're talking about an LLC that we treated as a partnership for tax purposes.
Correct.
Correct.
Yep. So LLCs can be treated as partnerships or corporations, depending on how you
That
want.
operating activity would flow up to the S Corp.
Yep.
Yep.
There's a presentation by John, you probably all seen it, on a positive side called Old Company, New Company. This stress is another way to look at that. On the positive planning side, there's a way to do it as well. It's in there in your video.
And what's the name of that Old Company, New Company presentation on LLC planning? LLCs just give you a lot more flexibility, both in how you compensate people, the hooks and the stick. I call them sticks and carrots that you can use to motivate your employees.
Yeah, definitely. Another method that I've used similar, I guess, in some respects, is getting to that LLC point. We've inherited a few clients from time to time that have real estate inside of a C Corp, which is awful. So what we'll do, especially if it's an older generation that owns a C Corp, which is very common, we'll elect S, get through the 5-year holding period to defer, or to eliminate that built-in gain and the double taxation, with the idea that it's an estate plan, so that if the owner at that time passes away, that at that point we can move it to an LLC with a step-up in basis.
Death is the ultimate tax planning strategy.
Right.
I was taught that in 1986 in my first tax course, and I'll never forget it. And it still is.
What do we get out of it? Obviously, with the things that we're talking about, you get significant long-term benefits with more vested employees, ability to potentially transition the business, long-term growth of the business through increased involvement by the new owner. Avoid competition, stealing your best and brightest, which is huge in today's market. I know even within our own organization, we've got a full-time recruiter, so we're constantly looking for ways in which we can get our competitors' best people, and I know that's going on everywhere. New owner has an incentive to raise the value of the company with a direct long-term benefit, entrepreneurial attitude, and innovation mentality. Some of the best candidates, what we do a lot of times when we sit down with a business owner is we'll say, you know, Paul and I were talking about this morning, do you really know what's going to motivate your employee? You know, they may think that giving ownership is the way to do that. They may think that it's, oh, if I just compensate them enough, give them enough time off, that's going to be enough. And so I think it's key on the front end to determine what it is that motivates that employee. Is it going to be stock? Is it going to be compensation? And you maybe want to share
yes.
your example that you shared with me.
So I'll tell you a quick story. So I picked up a client probably 5 or 6 years ago. I'm at my country club, and a good friend of mine is having dinner with this guy next to him. And I don't do business with friends, but all my clients become very good friends. And so I get introduced. Jeff introduced me to Brad, and I said, "Hey, Brad, how are you?" He goes, "Good." I said, "What do you do for a living?" He goes, "I'm an animal ophthalmologist." And I go, "Oh." He goes, "What do you do for a living?" I said, "I'm a furniture whisperer." He goes, "You're a what?" I said, "I'm a furniture whisperer." I said, "My clients hire me to talk to their furniture to figure out what bothers them." I go, "An animal ophthalmologist, what is that?" I go, "What is a trigger? What does it say now, trigger, on the eye chart?" And he goes, I'll tell you what, my clients bring me their dogs that are blind, and I restore their sight good enough to know the difference between a wall and the opening and the grass and the sidewalk. Well, despite that exchange, he became a client, one of my best friends now. And probably 2 years ago, he's got a very robust practice, multi-state practice. He said, "I need to get my doctors vested in the business. I want them to become owners." I said, "Are you sure you want them to become owners?" "Yeah, absolutely." I said, "Are you sure they want to become owners?" He said, "Absolutely." I said, "Let's talk to them first. Now let's just figure out what the plan is." So we came up with a very robust plan. By my standards, it was a great plan. It provided a lot of upside. The tax treatment was good because half of it was structured as deferred comp, which would have given the company a tax deduction when they left. We put this plan together. You know how many physicians bought in? 0. Nobody wanted to be an owner. So before you begin, you got to make sure that if you're going to be bringing ownership to these people, even if you're giving it to them, that they want the rights and responsibilities and that they understand what being an owner means to a business. Very, very important.
Yeah. Which leads to bullet point 2, motivated employees who are asking for ownership, because not everybody wants that responsibility of being up at night. High performers, it sends the right message of the culture that is expected in the organization, and someone willing to help with a plan of succession. The downside of stock compensation, of compensation in general, will it ever be enough? You give somebody a bonus, they start to expect it, it's an entitlement. Are they going to continue to work hard for it? Can be costly in terms of productivity and dollars. Can create employee dissension if other employees find out and don't have a similar package. And all of these, in general, I guess, are the opposite side of a stock, where I guess I feel like if somebody has ownership, they feel like they're more vested in the organization and the direction it's going. Focus of the work becomes competitive instead of based upon quality. Lower medium level performers who are essential may grow frustrated. Oh, sorry. Lower medium level performers who are essential may grow frustrated and eventually feel underappreciated. It's easier to leave if you're not an owner, clearly. And management incentive plans can be difficult to create, to make it so that there's a risk reward in the process.
We briefly touched on built-in gains. Who knows what built-in gains is? Roughly half. So, huh? Yeah. So this is an issue you may come across, and with smaller clients, you'll see it more and more. So corporations pay a corporate level tax, and then the owner pays a dividend level of tax when the second payment's made. Buffett brags about his tax rate being 25%, but that's because Berkshire Hathaway has paid 50% already, and now he's paying another 25% on top of that. S corporations, there's only one level of tax. It passes through to the shareholder. So if you're dealing with a company that's a C corp, what used to happen is the owners would say, well, I just want one level of tax, so I'm going to elect S status, right? I'll only pay one level of tax. The IRS says, if you do that, we are going to presume that you did it to avoid taxes. And the value that existed in the company on the date you elected S status is subject to double tax. So if you exit after that, you're going to pay 2 levels of tax on the value that existed. Any future appreciation, there's only 1 level of tax. And if you wait 5 years, we'll believe it wasn't tax motivated, so the built-in gains tax just disappears. So just so you're aware of what built-in gains is.
That means that there is no tax at the time of the event.
No tax at the no tax at the time of the S election. Okay, unless, but you got to be careful. I mean, we're going to get kind of esoteric here. I'm a tax CPA, so I could talk all day about this. But if you elect S status, you could be triggering built-in gains tax the next day because you have to look at the assets in the balance sheet. If you have cash basis accounts receivable and you're collecting those, that's considered disposition of a built-in asset. So one of the strategies is you create a built-in loss through a deferred comp to offset the built-in gain asset. So the answer is it shouldn't, but if you're not aware of the rules, it can. So make sure you're working with a CPA that's aware of those rules. It's
It's 5 now. That's
It was
made
10. It
permanent.
was 10. It's down to 5 now. So there was some big donor that wanted it to be 5 years. You know, back when I started, you could be an S corp. You could have, I forget, 20 owners or 25 owners,
Right.
and then it became 50. Then it became 100. And now, if you read the regs, it's infinite as long as it stays within the family member. And does anybody know why that reg was put into place? What's that? Nope. The largest S corporation in the world is Mars. Mars Candy. Okay, and it's a and anytime somebody dies, it's a generational transfer, and the number of owners is increasing exponentially. So I'm convinced that that rule was put into place to accommodate Mars. Yeah, I'm sorry, back here?
What coaching do you have for us? What tools, BEI tools, do you use to present these different stock option plans and policies?
So in Epic, there's a good Q&A to go through. If you're a corporation, you're dealing in the stock options and phantom stock. If you're an LLC, you're talking about profits interest, capital interest, and phantom units as well. But in Epic, have you used Epic before?
Yep.
Yeah, so Epic has a good Q&A, and it kind of addresses those plans and gives a very good description of what each one can do. Sorry, we had a question up here?
It's okay, I'll catch you later.
Okay. Yes.
I know you didn't want to talk about stock appreciation rights, but I'm going to challenge you on that. So can you speak to the difference between stock appreciation rights and phantom stock plans?
Yeah,
Maybe.
so
Can you, I'm actually, that's not an area I'm real
So
versed
a
on.
phantom stock plan is basically, let's go back to our example where Eric and I own a corporation that's worth $1 million, and we want to entice Elizabeth to come work for us. And we say, Elizabeth, we got 100 shares between us. We got 90 shares between us. We're going to give you 10 phantom shares. They're not real shares, but those 10 shares are going to represent 10% of the value of the business. So if we go back to our example where we exit at a $5 million valuation, we issued those shares to her when the value was $1 million. She gets 10% of the $4 million, but because it's phantom shares, it's a bonus to her. All of phantom shares is a way to create a bonus plan that feels like stock. Still compensation, still subject to ordinary income tax. The owner gets a tax deduction for it. She's a little bit more vested, but I don't have to put up with her as an owner, right? She's not showing up at meetings unless I want her there. She's not voting. She doesn't have the rights of access to records as an owner. But it's a way for her to track what she has as the company's value tracks over time. And stock appreciation rights, I've read about those. I've never worked with them before. I think they work similarly, but you actually own the stock and you get compensated based on the stock as it appreciates.
Yeah, that's my understanding too.
All right, help me out. Tell me about stock appreciation rights.
You draw a line in the sand, so basically here, it's like phantom stock, sort of.
Well, we have an expert in SARS out here. Go ahead.
Basically, the difference on phantom equity is based upon the value. So when you have an employee who's been with you for a long time, and who's helped build the company up to where it is, phantom equity like more appropriate. So you've got a starting valuation of $4 million, you are about this interest, not stock. Then when all is sold, or if there's another triggering event, death, disability, whatever, they get based on the whole value of the company. Stock appreciation rights is really the same thing, except you take a starting valuation of $4 million and award your SAR units. Those SAR units at day one have a single value.
But it's stock.
Right.
It's not stock.
It's only on the appreciation.
So what's the difference between phantom stock and SARS?
Phantoms on the whole company's stock appreciation is just from the line in the sand forward.
That's what Phantom is
No,
too.
you can't. Well, for phantom stock, you can't issue phantom stock. If you issue phantom stock that has value, there's going to be a taxable transfer. So the way we issue phantom stock is we do it based on future appreciation. But what he's saying is, if we were to give Elizabeth 10% phantom stock, she would be getting 10% of the company. The concern I would have there is there'd be, or 10% of the value of the company, there'd be a taxable transfer. But what stock appreciation rights are is it's more like a profit unit with respect to an LLC where you only share in the future appreciation. On the, So stock appreciation rights, you're actually given equity that has zero current value that appreciates as the business appreciates. All right. All right. So it sounds like it sounds similar to a profit unit in an LLC. Okay. Right. Okay. I can't hear you, I'm sorry. I'm not a GAAP person, but as I've, just through osmosis, I believe there is, but you need to talk with a GAAP person. Yeah.
Those rules have changed significantly, and there is, I don't know if it was, and I'm not a GAAP person either, but I think it was 2009. It gets put as a stock compensation expense if there's a determinable value, which a lot of these in privately held companies wouldn't. There's at least a footnote describing what the liability is.
I think you discount the value back. I think there could be an EBITDA hit or an earnings hit based on the options or based on the units.
Determinable value.
Yeah.
How often do y'all see these phantom stock things being done, and what's the threshold?
Repeat the question, please.
Yeah, he's not done yet. Go ahead.
He's asking how often.
Do you see these types of phantom stock type things put in place, and what's the threshold for business owners to make it worth their while?
Yeah. So the question is, how often do we see them, and what's the threshold for these types of plans? I see them all the time. A lot less on the corporate side, a lot more on the LLC side. LLC profit units can be problematic because they have to be revalued every time there's a transaction. Transaction being money raised or admitting a new member. So you could have a spreadsheet that tracks these things, and it's one of the areas that our firm has differentiated itself. Is there aren't many CPA firms that can actually track the economics and the capital accounts of profit units. But we see it happening on startups. If you're trying to get it, if you get a startup, you try to entice somebody to come over. What's the value of the company? It's going to be hard to entice somebody to come work for a company where the speculative value is $2 million if you're giving them ownership that he's going to have to pay tax on. So typically you give him some type of phantom units or profit units in an LLC, and he's rewarded on the upside. And then you only need to agree on what the base value is beyond which he gets compensated.
I would agree. I mean, we see it a lot in practice because of the flexibility that Phantom Shares offers to award somebody an incentive to build the business.
Other than a sale that you mentioned, when you talk about profits interest, what happens to the transfers of those profits interest, whether involuntary to agreements?
All right. So the question is, what happens to the profit interest when there are different types of terminating events? So when we construct these incentive plans and there are profit units, we define what's a qualified terminating event. Death, disability, or retirement are three very good reasons that somebody should be able to cash in their profit units. If you compete, okay, one of the problems with non-competes is they're difficult to enforce. The judge doesn't want to prevent somebody from making a living even if they set up shop across the street. So what you do is you can tie the profit units to, if you compete with us anytime within 5 years after retiring, and let's suppose there's a 5-year payout on the profit units, you can lose the value of your profit units, or we can buy it back for $1. So if there's theft, if there's acts discreditable, if there's some reason that the person left employment, then you can have a provision in there where the profit units can be bought back for a nominal amount.
Can be or must be?
It can be, but I can't imagine a business owner wouldn't do it. Yeah.
Yeah, it would be, most common must be, right.
For a forced sale at a
Absolutely.
nominal price. So, and that's an economic penalty. That's not a restriction to compete. You can, all right, fine, you can set up shop across the street, you just lost your $500,000 of value in your profit interest.
That's all state specific, right?
In Virginia, we do it in Virginia. I'm not, yeah. You talking about legally, can you do that? Or the non-compete? Yeah, the non-compete provisions are states. Yeah, it's all very state specific, exactly. So we use this strategy in Virginia, but there may be some. Virginia is a fairly pro-business state, but we'd still find when you talk to attorneys, if they're writing the non-compete, they're like, well, I don't know if this is going to hold up. But if you're challenging a non-compete, they're like, oh, don't challenge that non-compete. It's going to hold up. So it's hard to get an honest assessment.
Very true.
Right, right. Judge controlled. Any other questions?
Could you speak for a little bit about the decision-making process between having or encouraging a client to do true ownership through stock or LLC membership interest, as opposed to doing a phantom stock plan or another quasi-ownership vehicle in terms of what the legal responsibilities and difficulties may be in giving actual ownership? You have that discussion with your clients in this course or in conjunction with legal counsel?
We do. Yeah, and definitely, that's one of those decision tree processes we go through with our clients to say, what's going to motivate that employee, and plus it's also the business owner saying, am I willing to give up a piece of my business? Do I want them sitting at the table and dealing with minority ownership issues with this person? I mean, that's
in Virginia. If you're an owner of a corporation, you have access to records that maybe the owner might not want you to see. You can become a real pain in the neck if you actually have an owner. If you're a minority owner, you can file derivative lawsuits. You can be a real problem. But if you have phantom shares, then it's just a bonus plan.
right.
Still want stock, you can add non-voting shares.
You can still add
can.
non-voting shares,
That's
right?
correct.
So, but if somebody has what I tell people is if you own 49%, you own zero, right? Because if you don't control, you really don't have a lot of control. But the comment here was made you could give non-voting shares. Absolutely give non-voting shares. They still considered an owner under state law can still be problematic for you.
It would seem to me you still have the shareholders with self-fiduciary responsibility.
Yeah, and you still have the fiduciary responsibility.
The books and records and access to.
That's correct.
To some extent, you kind of have, similar.
Is the majority owner taking advantage of the situation? Am I getting screwed as a minority owner? All those issues come up.
Profit interests have access to records?
I think it's governed by state law. I think in Virginia they do, because you're an owner. Profit interest is an actual ownership of the entity. You own the entity.
Right. In Minnesota, they do too.
Again, in North Carolina, they don't.
They don't have access to it?
LLC Act that basically says in your operating agreement, you can do it.
Okay, said in North Carolina, there's a new LLC provision that says you can define in your operating agreement what access these people, the different levels of ownership will have in your business.
There's no law in North Carolina.
All right, yep.
So, quick question. So, when you recommend and design an incentive plan, either compensation or either equity or phantom, are you the accounting firm tracking that for them, or are you telling them to train their own internal finance team to track and maintain the incentive plan?
Both.
Yeah.
In my practice, yeah.
We make sure they're doing it right.
I mean, I think it depends on the level of expertise within the organization, and a lot of times we track it because they don't have it. Like Paul had mentioned, it can be a complicated process.
Now, I'll tell you that sometimes I've seen this, and I don't recommend it, is there's an agreement that says we will decide at the end of the year what the value of the company is. And what happened, a couple of things happen. Either number one, it never gets looked at, it never gets updated, and then there's an exit down the road and somebody gets bought out for next to nothing, or they can buy your stock for next to nothing. Or number two, it creates an interesting dynamic is if everybody decides what the value is at the end of the year, you can kind of see what people's motivations are. Because if somebody's arguing for a really high value, maybe they're not going to be here before the end of the following year, right? So if somebody's arguing for a really, really high value, then you may be thinking they may not be here very long. But what we do is we'll typically do evaluation the first year, figure out what metrics we want to use to determine what the value of the company is, and then we'll select maybe a multiple of earnings or a multiple of gross or a multiple of net revenue or EBITDA or whatever, and then we'll use that as a guide annually, and maybe we'll do evaluation once every so often. But I'm not a big fan on paying for unnecessary valuations, even though we do evaluations.
We do the same thing, and we coach our significant clients to have an annual meeting where we discuss that and we establish the value. It gets put in the minutes so that you avoid the issues that Paul talked about down the road.
All right, I'm going to jump into my presentation real quick. A little bit of background.
Yeah,
What do I do?
I don't know. It went to this after mine, so.
I close that? Or yes or no? No?
I think
Do I want to delete the? All right, so let's see. What could go
we may
wrong?
need some help, Elizabeth, because it didn't roll right into Paul's after mine.
All right, well, while you're fixing that, I'll tell you a little bit. So my presentation is based on a question that a client asked me 9 months ago. All right, so give you a little bit of background on this company. Really, really cool company. Manufactures consumer toys. I'm 52, so if you're about my age, you may have grown up with like the creepy crawler thing where you squeeze the goo into the little metal mold and it went to the oven and cooked, or you had the Play-Doh Fun Factory where you squeeze out the tubes. That's what this company did. You go into their warehouse and they have these giant roll molder machines where they're making like backboards for pool baskets. These giant machines that look like these octopuses at the old fair and the traveling carnivals. These things go in these giant ovens and roll around. They throw like these plastic beads into these molds, and then out comes these backboards, or they making these extruded noodles, pool noodles like the Play-Doh. It's just a great place to go. So my first meeting with this client, the prospect, it was owned by the patriarch and 5 siblings. 3 of the siblings operated the business, and one of the siblings was the president and CEO, and he was the real guy making it happen. What I hate to see is siblings being treated identically. Okay, there's a difference between treating children fairly, equitably, and treating them identically. And in this situation, they did it right because the 2 brothers that were operating owned the majority of the business. They owned 55%. The father owned 10 shares, all voting, and the other 3 siblings owned the difference, which was another 35%. So my first question to him, what do you think my first question to him was? Anybody? What's that? Well, what do you want to happen? But when you talk about that structure, there are 90 non-voting shares and 10 voting shares. The father has all the voting shares. What happens when your father dies? And his response is, everybody gets 2 shares. Okay? So I said, you do realize that the non-participating children, your siblings, are going to control the business. All right, you and your brother are only going to have 40% of the vote. He almost threw up. Okay? He almost threw up. His father was entering the first stages of dementia. So luckily, it was a very cohesive family. He was able to restructure it. And so very successful business. 9 months ago, I got a phone call from him. I got to figure out a way to get my key employees stock. I said, why? It's an S corporation. I said, why? He said, because I think we're going to exit next year and I want them to get capital gains treatment. Well, the first thing you need to realize that one of the first things I brought up was if I transfer stock to somebody, that's a compensatory transfer. If it's an employee and I'm transferring stock, the fair market value of that stock is income. And it's going to be really hard to say 9 months before a transfer that the value is this, and 9 months later it's this, and that's all appreciation, not to mention the fact the holding period isn't going to be a year, so you don't get capital gain treatment. So, am I up and running yet?
I couldn't find it.
All
It's
right.
not next. Okay.
All right. So so my background is I spent 10 years at KPMG. I helped take Dollar Tree public. I handled Norfolk Southern audits, and I hated working with really large companies. I like working with closely held business owners. Right? I call myself a serial entrepreneur, but my day job is I'm a tax CPA. So the presentation, unfortunately, is all numbers, okay, which I hate, but I'm trying to illustrate a point. So the purpose of this presentation is not to create a value judgment on what's better between equity or bonus but it's merely to show you the mathematical calculation of how the two shake out to give the business owner more information to make an appropriate decision. All right?
What did you call it?
I forwarded it to them.
I think that's mine.
Open that up.
Yeah, that's the one I just did. Yeah,
And if you go to the end.
yeah, I did.
All right. It should be very difficult to do this without.
Tell us the concept.
All right. So what I did is I ran 4 scenarios. So in talking to him, I started thinking about if we transfer equity, how are your people going to end up net after tax? How much cash are they going to walk away with? And if you look at the business enterprise, including all the shareholders and all the key employees, and you transfer if they have ownership or if you pay them a bonus, you can get to the same net after tax cash position, whether they have stock or whether they have a bonus situation. So what I did is I ran 4 scenarios. The first scenario was we have a business owner that owns 100% of a business and he exits for $20 million. Okay, he's got basis of $5 million. How much cash does he or she walk away with? Okay, that's our baseline. So we on an exit of $20 million, I show you what the tax liability is, and I show you what his after-tax cash is. Then I come along and I say, okay, the second scenario, we have a key employee that we want to give a $1 million bonus to after the exit. So the exit happens, $20 million. Company turns around and pays the key employee $1 million, $1 million of ordinary income, right? But the owner gets a tax deduction of $1 million, an ordinary tax deduction. So his savings, his tax savings on that $1 million payment is going to be the reciprocal of what the tax cost is to the key employee. So when you look at that one transaction and you add up the net after-tax cash proceeds of the owner after paying $1 million bonus and the net after-tax proceeds of the employee after having received the bonus, it's identical, right? The aggregate tax liability between the two of them and the aggregate net cash after tax is identical under the first scenario and the second scenario. Just to prove that if you pay somebody a bonus, you're not creating a tax liability out of thin air. So then I ran a third scenario and I said, well, let's suppose that this owner only owns 95% of the business, that he has a key employee that owns 5% of the business, okay? So what would happen is a $20 million exit, $1 million would go to the 5% owner, $19 million would go to the 95% owner. And if you run through the calculations, the 95% owner gets capital gains treatment because he actually owns stock in the company. So the analysis shows what the 95% owner pays, his tax liability, what his net after-tax cash is. It shows what the 5% owner's tax liability is in after-tax cash. And if you go to the total column, in aggregate, it's the exact same tax liability and the exact same after-tax. Now, it's going to be a little bit different because there's some additional Medicare taxes when you make a bonus payment that's compensatory, but kind of as an order of magnitude, it's virtually identical. So I said, okay, so if my client says, I wish this guy owned 5% of my business, okay, I've always promised him something and never got around to doing it. I hear that a lot. So if the business owner had owned, and I'll tell you what the exact number is. In the scenario, had really good graphics and everything.
I'm gonna put it on the CPI number side under this section, and it'll be able to track the numbers.
The guy who did it for me actually came up with graphics, and if you may not be able to see this from the back, but it's the Apple logo shaped like a pear because he didn't want to create any potential trademark violations. So in the scenario, bear with me one second. Sorry. So in the scenario where the employee walks away with 5% of the business, he has 5% of the business, he gets $1 million of the exit proceeds. He pays tax of $257,500, and he walks away with $742,500. That's what he would walk away with if we had the foresight 10 years ago to somehow get him 5% of the company as an owner. Right? He would have walked away with $742,500. So all I did is I figured out what a grossed up bonus would have to be to him. You got to realize that the $742,000 that he's walking away with is after a capital gains tax rate, which is about half the ordinary income tax rate. So I calculated how much of a bonus the owner would have to pay him to get him the same $742,500. okay? And so the actual bonus amount that he would have to pay, not that it really matters, is $1,358,646. So if the owner who owned 100% of the company would have paid his employees, key employee, a bonus of $1,358,646, the employee would have paid tax of $616,146. The business owner would have saved tax of $616,146, and the key employee would have walked away with a net after-tax cash payment of $742,500. So the only reason I did the scenario to kind of prove to him that we could get him where he wanted to be without actually having to transfer cash ownership. And so BEI has these great micro groups. We get together and talk. So I kind of brought this up at one of the groups, did my presentation. They said, you need to come to the conference and present that. So that's what this is. It'll be on the website. I'm going to have to go back and tell my manager that his great graphics, they actually move on the screen, which is really cool. So there's going to be a lot of numbers on it, so you got to make it interesting for me. I just don't want to look at nothing but numbers. So it's not to say that equity or compensation is better or worse. It's just that when you hear somebody say, I need them to own stock because I want to get capital gains treatments, you can get there another way. You can still make the person whole just as if he or she owned equity in the business, but you're paying them a bonus.
Don't tell your manager I'm disappointed.
I'll tell them how great it was.
There you go.
Yes.
But in that situation, in the cost, right, the aggregate tax was a little bit more than this.
No, because the business owner, anytime the business owner pays a bonus, he's getting an ordinary tax deduction. So he's saving money to higher than capital gains rates. So if you would think of an Excel spreadsheet, which I had, the savings to the business owner is a savings, and the cost to the employee is the identical cost. So when you net them together, all you're doing is you're shifting cash and liability to the key employee. In an aggregate, if you look at everything in an aggregate basis, after-tax cash is the same, and the income tax liability is the same. Sorry.
So in a phantom stock plan, at the end of every year, are they getting like a bonus equal to what their distribution would be, or is that only at the exit or triggering?
That's a great question. The question is, on the phantom stock plan, are they getting bonuses at the end of the year or only at the end when they exit? And the question is, it depends on what you want. Typically, phantom stock is, so I'm a believer in that you need two components to motivate an employee. You need a compensation plan that needs to be measurable. BEI's got great metrics on it needs to be simple, it needs to be measurable, it needs to be significant. That's to motivate current behavior, and then the phantom stock is for long-term behavior. And so we typically have a compensatory component, and the phantom stock is just something that's ultimately paid off at upon exit.
We see 5-year vesting typically. And we value it every year so that they know where they're at.
We've got into situations just like this, and I had an advisor say, both the attorney and the accountant say, you should be gifting.
To whom?
The magic.
You can't gift to an employee. A gift to an employee is a compensatory transfer.
That's kind of what I've always heard.
Exactly.
They said that there's a relationship there,
No,
Unless it's family member.
it's got to be family.
What I've always played up too, and I'm sitting there, both the attorney and the accountant say, well, there's a long-term relationship here.
We could be challenged on that conclusion?
So is there really any reason gifting versus stock bonus? Because
Gifting to whom?
have enough taxable income, aren't we just, if we gave a stock bonus, and grossed it up and paid the guys taxes, aren't we just shifting where the taxes are being paid without really creating any tax?
Yeah, so the question is, why do stock if you can get to the same place for bonus?
No, I'm talking about stock bonuses. So if I have to, as you say, gifting a stock, if I have to give stock to an employee, 9 times out of 10, it's a family member employee. Right. Why not do a stock bonus where you gross it up? You're just spreading who's paying the tax on the income line.
Correct. So you can do a stock bonus plan, which is instead of paying somebody in cash, you pay somebody in stock. If you work for Microsoft, you could get some stock. You gross it up to cover the tax liability. So you're transferring that at a current value out of your estate at a cost of the tax of the cost. But the rules that are changing now is on actually being able to discount that. So what we used to do back in the day, which we can still do until the end of the year, is if we had an S corp, we may consider recapitalizing it. If we, in the example I'm thinking of, we had a father and 3 sons, and so we recapitalized the company into 25 voting, 75 non-voting shares, and then we transferred the 75% into 3 defective grantor trusts. So we took significant discounts for lack of marketability, minority discounts. The IRS is saying because the family unit still controls that after this year you can no longer take those discounts. But if you're just going to you could certainly just transfer the stock to an employee or a family member through a bonus, and it would transfer at current value. Pardon me? And not. Correct. And if the income's high enough, you wouldn't create any tax because you're getting the tax deduction on one side, you're paying got taxable income on the other.
Right.
Correct.
Quick question. So you got $1.3 million, any issue on reasonable comp? Is there a reasonable comp issue here?
Yeah, good question. The question is, you got $1.3 million compensation, a reasonable comp. My experience has been a reasonable comp is in the C Corp area. The reason reasonable comp is an issue, so the IRS says that you can get paid for 2 things in life. You can get paid for other things, but 2 things in life. One is what you do, and the other is what you own. Okay? So if I own a C Corp, and I have a $10 million salary and the profit is 0, the IRS is going to say, look, your services aren't worth $10 million. They're maybe worth 1, and you're going to pay dividend tax on the other 9 because it's a distribution of profit. Okay? What was the question again? Oh, reasonable comp. So what they're going to say is $10 million is an unreasonable comp level. The reason they do that is because they want to tax that money twice, once at the corporate level and once at the dividend. If this is if you're just giving an employee a big bonus, I've never seen a reasonable comp issue come up because they're not an owner.
In the S corp arena too, I don't run into any issues with that at all, other than when I've had clients that have large distributions and 0 salary.
Yes.
That's a problem.
So the reason people do that is they'll have very small or no salary in an S corp. As an S corp, any salary that comes out, you pay employment tax on. That could be as high as 15.3%. If it comes out to you as a dividend, you don't pay that 15.3%. Up until very recently, the IRS, as long as you had some level of salary, the IRS didn't really challenge you. And so if you had a $10,000 salary and a $200,000 distribution, you were okay, but they're starting to cherry pick cases and they're having some success. If you claim 0 salary, they'd come in and say it's all salary, it's all subject to self-employment tax. So this theory of pigs get fed, hogs get slaughtered, right? You don't want to be at the FICA max, but you don't want to be at $10,000 either. So maybe there's a happy medium where you're able to save some employment taxes by ratcheting your salary down in an S corp environment. But that comes with other consequences. Yeah. Deferred retirement plans get impacted. But at any rate.
So if you have a profit interest,
profit interest arrangement.
Somebody retires, and that value's been, they've created $1 million of value there. How do the companies typically finance that thing?
Okay. So the question is, if you have somebody who retires with profits interest worth $1 million, what we typically do is we'll have that profit interest represented by a deferred compensation arrangement that's paid out over 10 years at 0% interest. So that employee, when he retires, would receive $100,000 a year, and it would be funded under current income. And what we typically do is we'll say that those payments can't be any more than 15% of cash flow, right? Because we don't want to burden the current owners. So in our firm, we do something very similar. Our partners are between the ages of 65 and 38. We have them staggered really well, and we were already looking at the next generation owners. But we tell the owners, when you retire, your deferred comp's going to be paid out over 10 years. If you don't coordinate your schedules together and your deferred comp exceeds 15% of income, then you may take you a lot longer than 10 years to get paid out. So we typically cap the payout based on some percentage of cash flow. And that way the company gets a tax deduction for it as well.
Ours is exactly the same. Yeah.
So I think that might be the last question we have time for. But I guess you'll stay for a minute if there's another one up at the front of the room, right?
Yep.
Perfect. Thank you very much.
It was a great presentation. I wish you could have seen it. $90 million. We had to give some of the key employees stay bonuses to stick around, right? Well, I had another client come to me and say, who's the best CFO in town? I said, you need to talk to the CFO of this company that just exited. but based on my advice, he had a stay bonus that he had to stick around another 6 months to help in the transition and couldn't go work for my other client. So he's gonna sit on his hands and wait 6 months. So these types of plans can be used to make your key employees stick around after the exit too, because that's very important in the transition.